Welcome to this walkthrough of the updated mobile app financial model template from efinancialmodels.com. The purpose of this model is to give you a tool to prepare a financial plan and plan the fundraising for a mobile app or similar software business. This model goes 10 years out and builds detailed financial projections, which are then aggregated to 10-year financial forecasts and also 10-year corresponding cash flow projections. The model has various uses. So, for instance, it tries to answer specific questions such as, for instance, how many app installs and active users can we reasonably expect by when? How can we monetize our mobile app, and what will be the sources of revenue? By when will we achieve break-even? How many active users do we need to achieve break-even? How much funding will our business require? What kind of return investors might expect? When can we exit, and what is the targeted exit valuation? How much equity stake can we give away to investors? What is the effect of using our funds to invest in paid ads? Will it lead to increased profits, or will it just absorb a lot of our cash? These and various other questions our model tries to answer, and the purpose, as you can see, is to obtain a comprehensive picture on the financial future of our mobile app business. So let's dive into this model and let me give you an overview how this model works. Before we go further, just a note, there are a lot of sensitivity tables included here. Every time we do run a calculation, these will be updated, so this can lead that the model becomes slow or does not react. So in order to avoid this, we select here that the sensitivity tables are not updated every time. If you want to update it, we will set it back here, but this is the setting we are normally using to efficiently work with the model. This model has different tabs. You see here one tab, that's the main tab with the executive summary. It contains the assumptions and the main output of the model. We have here one tab, which basically is the operating model. It includes all calculation to derive the revenues, the costs, and the financial forecast on a very detailed basis. We have here one separate tab which deals with the whole subscriptions and the renewal of the subscription, the churn rate, all these calculations, they are taken care of here. These tabs, they are both, they go 10 years out and they're based on a monthly forecast. The reason is that the app business is growing. It's quite a growing business, and every month basically influences how the growth is of the next month. So that's why we decided to build it this way. We have then another tab, which is the yearly tab, which is basically a summary of the monthly financials, and it aggregates the figure to obtain a picture what's happening on a yearly basis. Other tabs, one tab looks into the user lifetime value to see what's the user lifetime value of one user or of one app install, how much worth if we acquire one new active user or one new app install. And then we have another tab which deals with the number of required active users to achieve a break-even on an EBITDA level. So this is a bit the structure of the model. Now let's look at let's look at specific topics. The first topic to look at are the number of active users which will be using the app. This obviously depends on the number of app downloads which will be obtained during the course of the lifetime of the app. And for this, we basically have two sources where we can get app downloads from. One is an organic source, meaning people come to our website based on on certain marketing techniques. They get aware of the app, they start downloading. Here we just simply estimate how many app downloads we expect to get for each year. And then we have a second source of downloads, which are basically the paid downloads. This here depends of the available marketing budget, and then how much the cost per click and what's our conversion. So this gives us the number of downloads. This the detailed calculations are done on this sheet, on the monthly sheets. We have here the marketing budget. We have here the organic downloads. There are different ways to just to make it easy. We estimate number of organic downloads per year, but the allocation during that year, there are two ways of doing it. Either we basically manually just estimate how the allocation is, or we can also use a formula to simulate a bit a growth pattern. This you can play around and basically see which formula works better for your case. There are two models. Depending on that, it gives you a different pattern. You see here the green, these are organic downloads, and light green, these are basically the paid downloads. If you do the step increase, you see that the organic app downloads, they slowly get bigger as your marketing activities get better, and also the app is getting receives more awareness and interest from app users. Once you have the the app installs and the active users, basically you are set to basically look at how much revenues these active users can generate during the lifetime of the app. That's basically our next topic we have to look at, which are the sources of revenues. If we look here at the financial situation, we see here that the revenues they go here, basically they grow exponentially. And we also see here that we have different sources of revenues. This model for mobile apps, the normal ways to obtain revenues can be from paid downloads. If you have a paid app version where you can charge per download, you can also get revenues from in-app purchases if you have to sell items while using the app. Then also revenues from subscriptions model or advertisement-based models. All these calculations, they're basically included here in the monthly sheet, and you can basically work through to see if how to fine-tune these these assumptions. The key assumptions for these revenues you will find basically here in the general assumption section. That's at the end of the executive summary. You have here the monetization section. You need to work through these assumptions to see what the split is between free, paid, in-app purchases, etc., etc. You need to work this through. If you don't need, or if you don't use certain types of revenue sources, you can simply switch it off here, and then it will not be included in the financial plan. You can check this by simply going here and verify that these are indeed not included. So this, in short, is basically how the sources of revenue work. Then we also need to forecast the costs. The cost section, we have one type of costs are basically investment type of costs. These are software development costs. The capex, we just enter basically the amounts which we foresee to be invested during the forecast period. Then we have cost of goods sold. We have one basically direct cost. One cost are the commissions. We have to pay the app stores for any revenue we get. We normally have to pay up to 30% commissions to these app stores, and this is basically included in this row here. But also the model foresees to forecast other type of direct costs, which maybe are dependent of active users, or it might be fixed cost per month, or There might be percentage of sale, whatever you have here, basically a way to input this and to forecast, and in this way build your forecast. The other costs are OPEX related costs. Here you have a template to input your full-time employees. They are basically set as per three different hierarchies. Also here you can basically it is somewhere you can basically set the salary. You see here the salary levels depending for the three hierarchies. So all you need to do is set the salary levels and then forecast how many employees you will need to operate this up. Then to build the rest of the OPEX, you will have to basically input here other OPEX costs. This can be fixed amounts if you have them in available, or you can also enter here a percentage of sales amount. All this together will give you the OPEX budget for for your app projects. So this basically, and all these assumptions, they will basically run through here the monthly sheet, and then they will also go flow into the yearly in the yearly sheet and build your forecast. You have here the income statement. You have here the balance sheet and the cash flow statement. All the other tables are basically derivatives or calculations based on these financial figures. So what we want to do next is we want to determine, based on our forecast, how attractive is that forecast from a financial feasibility point of view. So what we do is we want to basically figure out the free based on the free cash flow calculation. We want to figure out what's the profitability, how much funding do we require, and what's the expected return for this. We need to paint a investment scenario, and for this we also need to assume that we should that maybe the app can be sold, or that there will be an exit event within 5 to 7 years. So for instance, in that case, we can, for instance, foresee that we have a project time of 5 years. It will shortly update. So you see that the free cash flows will go up here, and then we basically calculate our scenario based on a 5-year investment period. You can verify that in here we have a table about free cash flow calculations, and you see they will stop depending on your investment scenario. These are the cash flow which are needed to determine the IRRs, the profit, and also the funding required. You have here different IRRs. We start first with the unlevered IRR, and we figure out how much funding is needed, how much profit is achieved, etc. In case you use debt financing, there would be tabs, which is a bit unlikely for mobile apps, but in case you would use, you could enter how much of the funding amount you like to finance through debt, and this will basically impact your levered IRR. It will, here in this case, if you lever and make use of cheap debt financing, you can increase the IRR and your funding goes down. I now reverse this, but just to show that the model would be ready to do that. What we also have here is we have a reserve. Sometimes, or basically most companies, they will raise a bit more financing than what's the absolute minimum, just to have a bit of buffer. So what you can do here, you can basically goal seek to basically the funding amount you want. In this case, let's say we want to do 2 million, and we simply put the cash buffer accordingly so that we have an equity investment ticket of these 2 millions. Then so that's this IRR. Then this IRR, there are 2 ways to look at it. We now looked at it based on a free cash flow to equity calculation. Either we can leave it at that, or we can use a cash in, cash out calculation. What we do here is more that we take a kind of adjusted cash flow view, And all we do here that from an investor point of view, which is a bit different than levered cash flows, we just move the investment. You see here the cash flows are negative during 2 years, but funding is raised mostly at the beginning. So what we do is we just say that we invest this here at the beginning. This has a slight impact on our calculation, and that's basically this this IRR. What we also can do in this model, we can simulate the impact of different exit valuations on the financial situation here. So to calculate in year 5 the exit value, at the value the app can be sold, we can either value the mobile app based on revenues, based on EBITDA, app installs, active users, subscribers. There are many ways to do it. This model offers you 5 ways to do that. And the idea is that, that you can try to see which assumptions are you're most comfortable with, and then basically zoom in and see what's the difference between the different valuation methods, and then decide on using one of these assumptions which you think is most reasonable and can be defended. Of course, you need the data to substantiate this, but this will be the challenge to figure out what's the most reasonable assumption and which can be defended here. So that's the topic about financial feasibility analysis and basically the profitability of this project. Then what we also have here is a uses and sources of funding table. We basically have here a suggested breakdown how this can work. What we do is we start here with the equity ticket of 2 million. There is no debt involved in that case, and then here the model gives you a breakdown what's the corresponding allocation for this 2 million. This is a bit tricky, so sometimes if needed you will have to rework this and just overwrite this with your own figures how you want to present this breakdown here. Then we also go one step further. We look at the whole business plan from a fundraising point of view. There are different topics we have to look at. One is how much equity stake the founders will keep and how much equity stake they will give away. So we can basically here allocate the target equity financing structure. If I change here the assumptions, all assumptions are in blue, so the idea is that you first work through the blue assumptions and change this, and then you can basically see what's the effect on if we basically give more investors a higher equity stake, and then we can see what happens to the to the IRRs of the investors and also the founders. Also, it makes a difference if the founders put in cash themselves or not. And for this, we can also say how much of the required cash is provided by founders, how much is by the investors. This is the breakdown here, and here you will get the effect. You can see the effect of on the IRRs. In case investor in this case might say, okay, IRR is a bit too low, so there are different ways to correct. We can say, okay, the founders will contribute more of the financing, or in many cases it's not possible because the reason you raise funds is because you need funds. So let's say the founders don't have money to do that. So the way to increase IRRs for investors is to increase their equity stake. So if we give investors, let's say here, more of the pie, their IRR will go up. The founders' IRR would actually go down. In this case, it's not possible to calculate the IRR because the investment is 0 from that calculation. So that's one way to figure out. The other way is that you have to look at it from a pre and post money valuation point of view. The equity injection, 2 million here, determines based on in this case, you 2 million invested for a 75% equity stake. Therefore, you have a pre and a post money valuation, and your job will be to check if that's a reasonable, basically if that's a reasonable calculation. Another section we have in this model is a sensitivity analysis. For this, we now have to turn on sensitivity table calculations, so we'll do that. And what we now can do is we can select on which IRR. Here the sensitivity is based on IRR. The table should run. So I can go here and, for instance, select any IRR I want to look at, investor IRR, or in this case the adjusted IRR. And basically this table tells you what happens if we increase our marketing budget up. Okay, our IRR actually goes down. That's an interesting. No, actually, if you have less marketing budget, the IRR is down. If we have more marketing budget, IRR goes down. It means it goes up. Means it pays off to invest in marketing, and also organic growth. If you have if you grow stronger, then it will have an effect on your IRR. And we basically run sensitivities and see what's the impact on all the key value drivers here. You have here a whole list of variables which are used. And interesting at the end is this chart. This chart tells you which impact, which change of 10% of the assumption has which impact on which on which value driver has which impact on the valuation. You see here organic growth, this has quite a big impact. The OPEX conversion to active users. So when you get app installs, it's very important to keep these people as active users. That's quite a key determinant. And also in case of subscription, of course, the more people you can convert to paying subscribers, the better. And then also in this case, you see that the holding period has quite an impact. If you would go lower or higher, this has significant change. In this case, it would tell us that maybe instead of 5 years, we should actually stay a bit longer invested. And then we could, in this case, we could adjust our scenario a bit. Now it takes a bit time to run through all this sensitivity table and have this update. And then you see the situation looks a bit different. Now the impact is a bit lower because it won't make that much difference if it's plus 1 more year, but at year 5 it's still in the phase of growth, so it will make a bigger difference. So that's in short a bit more about the sensitivity table. Now I want to turn off automatic update of these tables. We have another look at another topic here is our paid ad campaigns. So the question is how much are the customer acquisition costs for paid ad campaigns? So these figures, these are just example figures. These come from basically 2 determinants, which are how much do we have to pay per click and how much of the users we get to click on our ads basically convert in downloads. And this tells us how much is the acquisition cost per download. And these costs, they can change. They should not be assumed constant. That's one way to look at it. And the other way to look at it is we need to know if it costs $4 to acquire 1 user, is this a profitable strategy to pay this or not? So in that case, we have a calculation of the lifetime value of the customer, which basically uses our assumptions to run through a calculation to figure out on average what is the lifetime revenue a user or an app user generates. And we have here this per active user, but only 50% of active users actually kept the app. So on an app install basis, it's basically half of it in this case. And this means that we actually need to compare this $24, which is per app download, this is the average we get, On average, we get 15%. We get a 35% profit before marketing budget. So we deduct 65% of costs. We are remaining with the lifetime profit. From this lifetime profit, we have to pay $4 for the ads, and then you see we are left with a profit. So this means in this case, running paid ad campaigns is a very good idea. You should do it because you're making profit. And actually, in this case, we would have to go back and even increase the ad budget because it's such a profitable strategy. So that's an important topic because all the business plan depends on how many app downloads you can get, and that's a very important analysis to look at. What we have here below are more charts. We have here a composition of the lifetime value. We can also run this per active user, which just give you a bit a different dollar amounts. We have here a break-even analysis. The question here is how many active users do we need until we achieve EBITDA break-even? In this case, EBITDA becomes positive after 121,000 users. So we need to think about our business plan. What can we do to get to these 121,000 active users? And then we should, based on this calculation, we should be safe and our business becomes profitable. So these are the type of calculation which basically can be performed with this mobile app financial model. I hope this walkthrough was useful. You could benefit from this. And if you like this video, please give it a thumbs up. Don't forget to subscribe to this channel and visit our website efinancialmodels.com. A link to the model template is included in the description below. Thank you for watching.